Welcome to The Explainer. Today, we're digging into an absolute earthquake in the tech world. Just picture this for a second. Imagine a massive $200 billion tech giant, a literal bedrock of the enterprise market, just losing a quarter of its value in a single trading session. Well, that is exactly what happened to IBM on July 14th, 2026. We're going to break down the timeline, the numbers, and the massive shift in enterprise spending that caught Wall Street completely off guard. So here's our roadmap for today. 1. The historic 25% plunge. 2. Unpacking the Q2 miss. 3. The AI budget war. 4. Underlying health and bets. And 5. The 3 o'clock test. Okay, let's dive into this. Section 1. The historic 25% plunge and the immediate shock to the market. 25.21%. I mean, wow. That is the sheer magnitude of the drop IBM experienced in just one day. To put that into historical context for you, this was IBM's worst single-day plunge since records actually began in 1968. It surpassed even the infamous Black Monday crash of October 1987. For a blue-chip company of this size and legacy, a drop this steep is just almost unheard of. It practically erased decades of steady market confidence in a matter of hours. But here is where the math gets, well, kind of absurd. The disconnect here is just staggering. IBM issued a preliminary warning that their quarterly revenue would miss expectations by about $660 million. Yet the market reacted by wiping out roughly $70 billion in market value. You're probably wondering why such a disproportionate, violent reaction to a 3.7% revenue miss. Well, in the stock market, share prices reflect expectations for years of future profits, not just one quarter. So the market wasn't just selling the miss, they were aggressively selling the explanation behind it. Which brings us to Section 2, unpacking the Q2 miss, and the mechanical explanation of what actually went wrong. So IBM was actually scheduled to report its full earnings on July 22, but they totally shocked the market by releasing preliminary figures 8 days early. Expected revenue was $17.86 billion, but the actuals came in at $17.2 billion. That represents a year-over-year growth of just 1%, and that's a sharp, really disappointing contrast to the strong 9% growth they reported in Q1. Adjusted earnings per share also missed, coming in at $2.93 instead of the expected $3.02. Whatever momentum they had earlier in the year, it had clearly just vanished. And, the company's leadership didn't sugarcoat it at all. CEO Arvind Krishna bluntly admitted, "This quarter we faltered," noting that numerous large deals just straight up failed to close. He explained that enterprise clients abruptly froze their software budgets. For instance, major cybersecurity deals were paused as clients waited to see how Anthropic's imminent release of its new Mythos AI model would alter their IT security needs. The landscape was literally shifting under their feet, and IBM simply didn't react fast enough. Let's zoom out a bit for Section 3, the AI budget war and the broader macroeconomic shifts. Look, corporate IT budgets are not infinite, right? Right now, enterprise chief information officers are basically panic buying supply-constrained AI hardware. We're talking GPU servers, high-bandwidth memory, specialized storage, just trying to secure their spot in line before expected price increases hit. Because of this, every single dollar spent hoarding hardware is a dollar not spent on traditional software licenses or IT services. The AI boom is effectively squeezing out legacy software purchases. So if you're wondering why your favorite software stocks have been so volatile lately, this hardware hoarding is absolutely the culprit. And obviously, this had a massive industry ripple effect. When IBM dropped this news, it dragged down the entire software sector. Giants like Salesforce, ServiceNow, and even Microsoft took a hit as investors realized, hey, this budget shift could impact everyone selling software. Conversely, hardware companies like Micron and SK Hynix, they saw their stocks surge. The money isn't leaving the tech sector. It is aggressively rotating from the companies that write the software to the companies that build the physical AI infrastructure. Yes, but let's neutrally pivot over to Section 4, underlying health and bets, or what we can call the bull rebuttal. Now, what's really interesting here is that the core business isn't actually collapsing. Despite the overall revenue miss, Red Hat, which is IBM's prized open-source software acquisition, grew its revenue by 11%. And even more surprising, their distributed infrastructure segment, which actually sells the servers and storage clients are buying right now, surged a massive 37%. In fact, they exited the quarter with a massive $500 million backlog in that segment alone. Furthermore, despite all the widespread market panic, IBM still generated a highly defensive $4.76 billion in first-half free cash flow. This is a genuinely crucial metric. While growth may have slowed down, the company is still a cash-generating machine. I mean, they even raised their dividend for the 31st straight year. This kind of financial padding provides a massive, reassuring cushion to help them weather these short-term enterprise budget delays. And they're taking that cash and placing some absolutely massive long-term bets. We're talking about a $10 billion 5-year investment in quantum computing, highlighted by the CHS Act-backed Anderson Quantum Foundry. They aren't ignoring generative AI either. They've announced strategic partnerships to integrate Google Cloud's Gemini models and formed an OpenAI-linked cybersecurity partnership. These are foundational investments. They're designed to secure dominance in the next decade of computing, long after this current AI hardware panic eventually subsides.
All right, let's bring it all together in Section 5, the 3 o'clock test and evaluating the future.
And this brilliantly illustrates a framework analysts use to cut through all the noise called the 3 o'clock test. First, you have the quarter clock. Are these software deals just delayed to next quarter, or are they lost forever to AI hardware spending? Second, the decade clock. Can IBM actually maintain its highly profitable software moat as companies increasingly build their own AI tools in-house? And finally, the bet clock. How much is their massive push toward fault-tolerant quantum computing by 2029 worth today? Mixing these 3 completely different timelines up is exactly what causes so much investor confusion. Because analysts are looking at these different clocks, we're seeing one of the widest divides on Wall Street in recent memory. On the bear side, you have HSBC downgrading the stock to a reduce with a $191 target because they're deeply concerned about the deterioration in core software sales. But then on the bull side, you have Citi maintaining a buy rating with a massive $375 target, heavily weighting the future value of IBM's $10 billion quantum computing opportunity. That is a staggering 96% spread between the experts. It is truly astonishing to see professional analysts that far apart on a massive blue-chip stock. Ultimately, the immediate truth of this budget shift is going to be tested really soon. We've had the shock pre-release on July 14th, but the full Q2 earnings call on July 22nd will be the true battleground. That's when management is going to have to clarify if those delayed cybersecurity deals actually closed in July, and if their full-year free cash flow guidance will hold up. From there, the timeline stretches all the way out to 2029, which is their big target for a fully fault-tolerant quantum system. Which leaves us with the ultimate question. After a historic 25% drop, is IBM a massive buy-on-the-dip opportunity, or is it a value trap masking a structural decline in traditional software? Well, you now have the numbers, the macro trends, and the 3 o'clock test to make your own assessment when those full earnings finally hit. Thanks for joining me on this explainer, and definitely keep your eyes on the data.